the recognition. We did the recognition thing. Now it is classification. How did you classify your financial asset? This is actually your, how to say, the key area, and everything will start from here. So there are three categories of financial asset. The first category of financial asset is called financial asset at amortized cost. The second one is called financial asset as fair value through other comprehensive income. And you sometimes call it like this, FVOCI, fair value through other comprehensive income. This is the second category of financial asset. And the third category of financial asset is called fair value through through profit and loss, fair value through P&L, okay? So these are the three categories. Now, what does that mean? I will explain you. Listen, we talked about amortized cost. In last lesson, we discussed almost 30 minutes on amortized cost. So we'll go back to that knowledge and we'll try to, connect it. So three categories are, one is that you show it at amortized cost, or you do it as fair value through comprehensive income, or fair value through P&L. What does that mean? It means that this asset, when you say fair value through other comprehensive income, if I make it very, very simple for you, it means that statement of financial position in balance sheet, statement of financial position show at fair value. Fair value means market value. So when you say fair value, so it means that in balance sheet, we'll show it at the market value. And gains and losses in OCI. Gains and losses you will show in your OCI. Remember your statement of comprehensive income? We discussed the structure, the lowest part, the end of the bottom part, that is called the OCI part, other comprehensive income. If you talk about this one, it says that you should show it at, in statement of financial position, show at fair value, and gains and losses in profit and loss. Profit and loss means this part of the income statement which is above PBIT, like your operating income and operating loss. So when I say gains and losses in P&L, it means that you should be showing it as your operating income or operating loss part. Okay, the operating section you are showing it, which means above that PBIT thing. So the names are quite clear now. When I say fair value through OCI, what does that mean? It means that in balance sheet, you will show it at fair value, which means in the balance sheet, like when I purchased it, on 01/01/2008, I got it for, I don't know, $100. Now this is 31 December 2008, and the market value, in the market it is being sold at 110. So then this is the fair value. So I should be showing it at 110, not 100. This is what I mean here. So fair value means the market value take on the balance sheet. And if you make any gain or loss, for example, here you made a $10 gain. And this $10 gain, like it was 100, now it is 110. Where do I write down this $10? That $10 will come into profit and loss. This is one category. Another category, again, 100 I show in the balance sheet at fair value. I mean, 110 I will show here in another option, but that $10 I will write down here in other comprehensive income. That is the difference. If you talk about the first one, what do we do with that? We say that statement of financial position show at amortized cost. We discussed what is amortized cost last lesson. I will speak later. I will come back to that. And there are no gains or losses. So you don't talk about where to write down in income statement, upper or below, because there are no gains and losses. So it does not speak that you should be doing it fair P&L or OCI. It only goes to the balance sheet. It is not going to the income statement because there are no gains and losses. So this is
just one thing to clarify. When we do the amortized cost, we calculate the present value of the future obligation.
Yes.
And that present value we show on the balance sheet.
The closing value, end of the year, whatever it is in your calculation.
Okay.
We made that in Excel sheet in last lesson. I will go back here. I will go back there. I mean, that Excel sheet I've already opened. I will go back to that sheet today. I mean, although we did it, but we need to refer back to that. So first, we already understood now what are these names. So when you say that, oh, this is a financial asset at amortized cost, it means in the balance sheet, I will write down at amortized cost. And what is amortized cost? I know how to calculate. If you don't remember, we will go back to Excel and see. And it will never have any gains and losses. It does not have any gains or losses. Why? I will also explain this thing. I will explain. The second type is fair value through OCI. So when somebody tell you that this financial instrument is fair value through OCI, you immediately understand that in balance sheet, I will write down the fair value, which means 110. And this $10 change in the fair value, I will write down in OCI. But if somebody tells you that this financial asset is keeping at fair value through P&L, it means that in the balance sheet, I will write down 110, and the difference $10, I will write down in the P&L, the top part. So we are done with that. We'll come back to it. I know that you are thinking, how do we define which asset is amortized cost, which asset is fair value through OCI, which asset is fair value through P&L? Because you may have 10 different types of financial assets. And the question is, which one comes to this category, and which one goes to this category, and which goes to this category? This is now our second. Logically, we should be talking about this issue, that how to differentiate, how to put them into that certain category. So this is, we come here. We say that IFRS 9 classification is made on the basis of both. There are two things. How do you classify? Every financial instrument, when you see, you have to see two criteria. There are two criteria. The first is the entity's business model for managing the financial asset. Why do you purchase this financial asset? I mean, what usually is your purpose of making such investments? Do you make investments with an intention of keeping them until the end? Or do you make investments with the purpose of selling them? For example, let me ask you, sir, let me give an example. You can buy this bond. If I go back the example of that bond, which you purchased for $100, and this bond was giving 7%, and the life of the bond was 5 years. Now, what are your intentions? There could be three possible intentions, actually. Three possible intentions. First intention is, you call it held to maturity. Held to maturity means that, you know what, I purchased the bond, I want to keep it with me for 5 years, and I want to collect this 7%, like $7, $7, $7 for the next 5 years. And then at the end of the 5th year, I will go and return the bond and take back my 100. This is called held to maturity. The second one, possibly your other intention could be, you call it held for trading. Held for trading means that, I have no intention of keeping this bond at 5% for the period of 5 years. I will sell it as soon as in the market, its market price, its fair value will go up. I mean, the moment it becomes 105 in the market, I will sell it. I don't want to keep it for 5 years. It is not my intention to keep it for 5 years. Or the third one, either of them. I'm not really, so the first one, I'm strictly keeping it. The second one is I am selling. I purchased it with an intention to sell. The third one is I've kept it. Maybe I will keep it until the end, or maybe I will sell it. Any one of them, not either of them. Let me call it any of above. Any of above. So if the price goes up, I will sell it or not sell it, but I'm not sure. This is the third one. Now, by the way, there is one topic which is a little bit away from the chapter, but relevant to the topic. So let me explain you. I said that when the market price will go up, because I just said that when this $100, when this price $100, it will increase, it will become, say, 110, I will sell it. I said, if in the market it becomes 110, I will sell it. So why it becomes 110, or why this 100 goes to 90? What is this phenomena? Let's first understand this thing, because once you understand it will be easy. Things will be easy for you. Remember, there are two things. One is called face value of bond, which in our case is 100. And the other is called market value of the bond. It keeps changing. The first thing, $100, that does not change because that is written on the face of the bond. It is also called face value. It is also called par value, okay? It is also called nominal value. So there are three names. Either you call it face value, par value, nominal value. It is the value which is written on the face of the bond. It is $100. But then the bond has a market value. In market, the bonds are being sold and bought from morning till evening, day in and day out. And the price in the market is changing. Why the price in the market is changing? So you should remember, you should say that market price of bond and market interest rates are inversely related. Inversely related. What does that mean? It means that if in market the interest rates go up, bond price will go down. So I would write down here, like if I've got here, interest rates, and let me call it market interest rates, okay? And here I would say market price of bond. So these are two things, and I said that they are related. How they are related? Inversely related. Inversely related means that when market interest rate they go up, bond prices they go down. Why does this happen? Listen, imagine that the banks, market interest rate means primarily coming from the banks, which I call market interest rate, is 8%. So banks are telling people that you come and deposit money in a bank and we would give you 8%. So when banks are offering 8%, who in the world would be interested in keeping money with this bond? Because the bond is giving 7%. Investors, they want better returns. Investors are looking for better opportunities for their money. Bank has just announced that the bank is going to give 8%, So what will happen? Everybody would start selling the bond and start putting money into the bank. So these bonds, nobody's interested to buy the bond. So I've got a bond in my hand, which is giving 7%. I go to the market and I say, listen, I'm selling the bond. I will not find a buyer, Nobody would buy it because everybody would say, why should we invest at 7% when the banks are giving 8%? So what will happen? That I will sell it for 95 to cover the loss of the investors, because investors will say, okay, you want to sell, we can only give you 95 because when we put money here, we start losing $1 per year. Every 1 year we are losing $1. So we'll give you less. And similarly, if the market interest rates are not 8%, they go down to 6%. If the banks are giving only 6%, now what will happen? People will start taking out money from the bank and start buying the bonds. Everybody will go to the bank in the morning, take out their money and go to the market to buy this bond because this bond is giving 7%. Bank was just giving 6%. So the demand of this bond will increase. Now I've got a bond. and somebody comes to me and says, will you sell your bond? I say, yes, I'm selling it, but I will sell it for 105 because my bond is giving more benefit. I mean, if you put money in the bank, it gives just 7%, 6%. Bond is giving 7%. Therefore, I am selling it at a higher price. So this is what you say, the relationship between the market price and the bond. And here comes held for trading. When you say that you are keeping the financial asset or liability, whatever, held for trading, you are just watching that as soon as the market price changes, you will sell it. You don't have any intention of getting this 7%. You are not interested in, and maybe you don't have cash to invest for 5 years. You just invest for a short period, for a month or two, during which the bond will go up in the market. You will sell, you will make your $10 and you go out. This is your business model. Here you talk about business model, that what is the business model here. So this is what we said, that there are two criteria. Criteria number one is, what is the entity's business model for managing the financial assets, which means how do they manage, how do they keep financial assets? Are they keeping it for the maturity, or they are doing it held for trading, or they are doing it any of the above? Okay. The second criteria, I'm spending a lot of time because these are the only two criteria which will work. Okay. Once we understand that these two criteria, there is nothing left. So the contractual cash flow characteristic of the financial asset, what this financial asset is giving you. Is it giving you contractual cash flow? Contractual cash flow. And what do we mean by contractual cash flow? Contractual cash flow, we call it, there is a word, SPPI. SPPI means solely payments of principal and interest. Is this financial instrument, does this financial instrument meet this SPPI criteria? Yes or no? Here you have to give answer in yes or no. I mean, you see a financial instrument and you say, does it meet SPPI criteria? Yes or no? Okay. Now, what is SPPI criteria? I say solely payments of principal and interest. I go back to my bond again, and I just actually erased it. I should not have. This bond was $100, and it was for 5 years, and it was for 7%. Okay. So what this bond was giving, this bond, actually there is a promise that whoever has this bond, they will get in 5 years, every year in 5 years, what they are going to get, $7 here, $7 here, $7 here, and these are 7, by the way. Let me put this link so that it should look like $7 here, $7 here, plus $100 here, the last payment. So in year 1, year 2, year 3, year 4, year 5, what you get 7, 7, 7, 7, 7, and 100. Solely means only payment of principal. Yes, only payment of principal and interest. This bond, it meets the SPPI criteria. SPPI criteria means that there is some contractual cash flow. I mean, what you will receive or what you have to give, it is agreed upon. It is not possible that you go to the company and they say, please take $6, or you go to the company and they say, we are not giving anything, or end of the 5 years, they say, okay, we don't have 100, you take 90. It will not happen. You will receive exactly 7777 plus 100. So that's a contractual cash flow. If you ask me, does this bond meet SPPI criteria? I say yes. This bond, it meets the SPPI criteria. Now, if it meets SPPI criteria, the second question, why did you purchase the bond? I say, I want to keep it to maturity. So my business model comes. If I talk about this bond, I purchase the bond with an intention of keeping it for the next 5 years to collect 7777 and 100. And the bond, the financial instrument itself, it guarantees SPPI. Listen, there are some instruments which do not guarantee the SPPI criteria. Like you've got shares. Okay, when you purchase a share in a company, share also has a face value. Share face value is $10. Okay, but there is no promise. They never promise to give me my money back $10, and they never promise to give me a fixed dividend. Sometimes they give me $2, sometimes they give me $1, sometimes they give me $3, and sometimes they don't give me at all. So a share does not meet the SPPI criteria. Share fails on SPPI criteria. If you talk about an invoice, okay, you've got an invoice from which you have issued to your customer. The invoice value is $1,000. Your customer must give you $1,000, and when they will give you, and it is 30 days because your payment terms are 30 days. What do you do with this invoice? What do you do with this invoice? You keep the invoice until it matures. You cannot do anything before that. So business model is, are you keeping it for maturity? Yes, this invoice we are keeping until maturity because we have to wait for 30 days until the customer gives us the money. And what will you get? Will you get 990, 1000, 1011, something more, something less? Absolutely not. I will get exact 1000. So this, my invoice, a receivable invoice from a customer, it meets this criteria. It is held to maturity because I have to keep it because there's a promise that customer would pay 30 days. I cannot ask him to pay early. Okay. So it is held to maturity, and end of the maturity, I will get my contractual cash flow. So this is, I mean, you have to keep these two criteria in your mind. So anytime you see a share, so share does not meet SPPI criteria because dividends are not share. Yes, if I talk about, now we are talking business now. See here, remember 20 minutes before what we were talking about? We were talking about preference shares. And preference shares, we said that these are redeemable, if you remember. We said redeemable 5 years, and we said that it is 6%. So if you talk about this share, which is an ordinary share, when I was talking about here, I was talking about ordinary share, because in ordinary share, the equity share, the dividend is not promised. So it does not meet the criteria. But if you talk about a preference share, 5 years duration. So held to maturity, probably 6% contractual cash flow. So you can say that your preference share can meet the two criteria. So you have to see, every financial instrument, that are you going to keep it or sell it? By the way, it is possible that these redeemable preference share I may keep for held for trading because I purchase the shares. So it could be here, but it is definitely giving my contractual cash flow. So you can buy preference share So the first thing, actually, they put it here in this way. The first, you decide, why did you purchase it? Do you want to keep it? Do you want to sell it? The second thing is what it will give you. Is there a contractual cash flow? You know exact amount, or you don't know exact amount? Like in case of a bond, if you talk about a bond, it gave me a contractual cash flow, but the share does not give me contractual cash flow. So I just removed it. We move forward, and now we talk about these three things. What is amortized cost? We said that these are the two criteria, and these are the three types. We have to see all three of them based on those two criteria. All three of them based on two criteria, we will make our judgment. So amortized cost. Amortized cost of a financial asset. What is amortized cost? I will not repeat the definition here. We did it a lot. Everybody knows that. Those who do not know that, let me see who does not know it. So, okay, we make a very short, quick view on what is amortized cost. So actually, this is in our previous lecture. I explained it in detail, but I'll just try to make a quick revision in 5 minutes. If you do not understand, please refer to the previous video. We started the story from here, that we issued a bond. The bond has, so we are issuing the bond, okay? We are issuing the bond. We issue the bond. We are not buying the bond. So when we issue the bond, for us, it is going to be a financial liability. The issuer has the financial liability. The buyer of the bond, the holder of the bond, it is an asset. For me, it is a liability. So I'm issuing the bond for $100 at 6% coupon rate, which means 6% interest rates for 5 years. What will happen? I will receive $100 today, and then I will give you $6, 5 years interest. And then end of the 6th year, I will also give you $100 back. So essentially speaking, I'm receiving 100 now, and I'm going to pay 100, 666 in future. And we know the concept of time value of money. We say that $1 today is not equal to $1 tomorrow. This $6, it comes in this first year, it comes in the second year, third year, fourth year, 5 year, fifth year, and this is also in fifth year. And we say that money loses value with time. So how do you and then you have to calculate discounted value. We call it present value. So we need to calculate the present value of this $6 after 1 year, present value of this $6 which we give after 2 years, and so on. And we do it with the help of the discount factor. Somewhere here we discussed that our discount rate is 8%. And we called it effective interest rate. That's a very useful term you should remember. Effective interest rate. What it is, I will tell you. Our effective interest rate is 8%, which means we will discount it at 8%. So what are our cash flows? In year 1, 2, 3, 4, 5, we give 666 and 106. And these are the discount factors from the discount table. You can take them from discount table. You can create them by yourself as well. And I explained in the last video how to take it from table and how to calculate yourself. Both things I explained. So I'm not explaining here. Anyways, discount factor is 0.926. So when you multiply, what you get here, actually, if I put them in points, it would be like 5.56. So this $6, which you give after 1 year, in terms of today, it is only 5.56, which means today's $5.56 is equal to $6 of 1 year later, if it is 8%. You should remember that we calculated it at 8% because our effective interest rate was 8%. So these are 8% factors. I will give this access of this video to everyone. If somebody does not have, I will give.
Sir, can you also share this Excel sheet on the email?
I not on the email. It is on the site already there.
Site?
Yes.
Okay. Actually, we cannot download it from the website.
Download. Excel sheets and PDFs are downloadable. Videos are not downloadable.
Okay. Maybe I was trying video.
Yeah. So then third year, so you can calculate this thing. So what it looks like, that this 106, actually what you are giving in 5 years time is $130. But the present value of this $130 is just $92. It is just $92. So this is our liability. Now that $92 is your liability. I will write it as of today. Okay. Because you received 100, but your liability is just 192 because this is the present value of all the future cash flows. So now you have to record it. How do you record it? Now we suppose that we issued bonds worth for $100,000. Okay, so this is just one piece of paper. This is just one bond, but I issued 1,000 bonds like this. Okay, under the same terms and conditions. So when you start multiplying it, this 100 rupees, $100 multiplied by 1,000 bonds, you got cash 100,000. You can, by the way, keep it as 100 for your sake of simplicity. And what is the liability is only 92. So what will happen? That you receive 100 today. This is your cash. This is your asset. But what you assume liability, that is just 92. I mean, the present value of all these payments. I mean, I have to give 130 in cash. When you count it, it is 130. But when you see the value, it is only equal to 92, which means whatever you can buy today, 92, after 5 years, you can buy the same thing in $130. So the difference between this 100 and 92, because you have to, make the double entry equal. $8, it goes to your equity. The difference of this one, $8, that goes to the equity part. So this is the double entry. So this thing which we were doing, we call it compound financial instrument. What I use the word, it is called splitting the equity and debt part. Splitting the equity and debt part of a compound financial instrument. Compound financial instrument means that within this bond, there is a little bit of equity and of course some debt. So this is one thing. Now what happens? I record my liability. Now let me take the numbers. So this is for one bond and I issued 1,000 bonds like this. So I got 100,000 cash and my liability is 92,000 and my equity is 8,000. This goes to my equity. Now I come back. Now the issue is that this goes to my balance sheet. I'm going to write down it in my balance sheet as my liability. So if this is my liability, SOFP, in 92,000, how would I pay this 100,000? Because I have to pay 1,000 people $100 back. So after 5 years, I need $100,000 to settle all my liability. I mean, I issue 1,000 bonds. Each bond is $100. So I would be needing, $100,000 on my balance sheet. You don't pay more than your balance sheet. My balance sheet says liability is 92. How can I pay 100,000? I cannot pay 100,000 if on my balance sheet the liability is only 92. So what I need to do now, I need to do a reverse process, which is called, before I was doing discounting, now I need to do compounding or unwinding. So what happens here? You come back here. So actually what you need to do, you got 100, but you recognize here as liability as 92. Your liability is 92, but after 5 years, you have to pay 100. Today it is 92. What to do that I make this 92 equal to 100 so that I pay it back. So what I need to do graphically, I first explain you. I need to somehow increase it, I'm increasing it somehow, which I called unwinding. And I have to unwind it for 5 years until it becomes $100. Okay, this is what I need to do, and I call it unwinding. I need to unwind it. I need to compound it. How do I do that? Now I make the table. Beginning of year 1, my liability is 92,000. Now if you remember that your effective interest rate was 8%. Your effective interest rate was 8%. So you calculate how much interest. So this is 92,000 multiplied by 8%, 7360. And then, so this is the interest which you should pay, but you paid only 6% because it says $6. So that is 6%, like 6,000 you are paying. So 92,000 plus this is how much I should pay minus how much I did pay, and my closing liability end of the year is 93,000. So beginning of the year it was 92, end of the year is 93. This 93 comes here. Then I take 8% of that, which is 7,469. Again, I paid back 6,000. This is my closing liability at the end of the year, 94. And then you go on so far. And you notice that at the end of year 5, it would be 100,000. This actually is 100,000. There is a difference of $21, and that $21 is because of some rounding off. Okay, it essentially should become $100,000, and then you will pay off your liability. And here are the double entries for this. You would understand. Now, this is called amortized cost. Now, if somebody asks you what is amortized cost, you will say amortized cost mean that I find out the present value of my liability, step 1, present value of my liability. Then I increase it with effective interest rate. I subtract the coupon rate, the interest rate, which I actually have paid out, and I subtract them. Whatever the balance comes in, that balance is called amortized cost. Now, this is kind of.
Sir, can you please repeat the definition of amortized cost?
Amortized cost, I said, the process of calculating amortized cost is that first you find out the present value of your liability, step 1. What I did, I'll just put it here. I'll call it step 1. Calculate the present value of liability, which in your case is 92,000. Step number 2, add effective interest rate, which in your case is 7360. Step number 3, subtract the interest paid, how much interest you paid, which in your case is minus 6,000. When you make a sum total of that, sum total of these 3 is your amortized cost. Now I tell you one thing, and I bet on that. I can bet on that. Please open up your books, any book, PPP, Captain, DDG, my level. They'll give you amortized cost definition. You would never understand it when you read it. I mean, unless you don't see the procedure, the definition is not so good to explain. I will go back to the definition and I will show you the definition. But you should understand there are only 3 steps which are written. Calculate the present value of liability, add the effective interest rate, which is 8% in your case, subtract the interest which you have paid, which is 6%. Sum total is called amortized cost. And now, if you remember, our first financial instrument category was amortized cost. And I said that SOFP, in balance sheet, you will show in SOFP, show at amortized cost. I said show it at amortized cost, like show at 93,000, 94,000. These will be the values, 93,360, 94,829, 96,415, etc. These will be shown on the balance sheet. This is amortized cost. And I said that no gain or loss. I said that in case of amortized cost, there is no gain or loss. Yes, there is no gain or loss. Why? Because you are not comparing it with the market. You only make gain or loss. What is gain or loss? Gain or loss means in my balance sheet it is 100, in market it is 110. I am comparing it with the market because my balance sheet is less, market is more. Oh, I made a gain. Or you say that in my balance sheet it is 100, in the market it is 90, so it has lost value. I made a loss. But in case of amortized cost, you are not talking about the fair value. You are showing it at this, and this is predetermined. You already knew on day 1 that how this table will look like. Okay, when you issued it in 2001 until 2005, your table was already there, and it is all planned. There is no gain, there is no loss, there is no unexpected, there are no surprises. You already know how much you will show it at the end of year 4. You already know how much you will show it at the end of year 5. So there is no uncertainty, there is no market check, there is no fair value difference, and therefore there is no gain, there is no loss. You just show it on the balance sheet on these numbers, and you don't compare it with the market. This is called amortized cost. So I'll go back to our PPT. And luckily, you can read the definition. Amortized cost, it says amortized cost of a financial asset or liability is the amount at which the financial asset or liability is measured at initial recognition. Initial recognition means your 92,000. Initial recognition, 92,000. Minus principal repayment, which means minus 6,000. Plus or minus the cumulative amortization of any difference between the initial amount and the maturity amount. And minus any write down directly or through the use of an allowance account for impairment or uncollectability. These are which you need to consider. But what you should do it simply, what I've explained to you. That would be all for you. In F7, you don't have this these other things, uncollectability step like this. Okay, so classification of financial asset. I come back, amortized cost criteria. The first category was amortized cost. If you remember, we had 3. Number 1, amortized cost. Number 2, fair value through OCI. Number 3, fair value through P&L. So first one, amortized cost measurement. A financial asset is classified as subsequently. Okay, now this is very important. It says subsequently measured at amortized cost. Why subsequently? Listen, you've got 2 measurements. First is your initial measurement. Initial measurement means at the time of purchase, when you purchase or sold the financial asset. And then you have subsequent. Subsequent means end of year. Initial means, when you become party to that holder of issue date, whatever. Initial measurement is always at cost. There is no difference. Initial measurement in all three cases, like we have 3 types of financial asset. Initial measurement you always do at cost. Just if you remember, okay, let me relate to you. It will be helpful for you people. I'll go back from the topic. Okay, please allow me, but it will help you to understand. If I go back, you had your tangible non-current assets. Remember, tangible non-current asset, land and building, plant and machinery. They also had initial measurement, and they had their subsequent measurement. Subsequent means end of the year. So what was the initial measurement in tangible non-current asset? Initial was cost. And what was the subsequent? Subsequent measurement had 2 options. In subsequent measurement, you have 2 options. Initial was always cost. Subsequent was number 1 was net book value, and number 2 was fair value. Right? This was the method of tangible non-current asset. When you purchase a non-current asset, first you write down net cost, how much it cost you. Second, either you do net book value. Net book value means cost minus depreciation. So net book value was what? Net book value was cost minus depreciation or minus impairment, whatever you call it. So this was your net book value, or you do it at fair value, like market value. I'm going to use the same thing here. here I say that initial measurement is at cost, just like you put here at cost, here is also at cost. All financial instrument. But subsequent measurement could be at amortized cost or at fair value. So it's the same. Subsequent measurement fair value is the same. Amortized cost has been replaced by net book value. So just like you calculate the net book value of a tangible non-current asset, for a financial asset, you calculate amortized cost. Like you said, depreciated amount or whatever. So here you do amortized cost. So issue is not with initial measurement. Initial measurement is cost, whether here or whether here. Our only problem always comes with subsequent measurement. When we were doing land building, plant machinery, we always thought about this. This one was no problem. And here, again, when we do subsequent measurement, this is the issue. What do we do? So we say that amortized cost category. So a financial asset is classified as subsequently measured amortized cost. Like you can only put a financial asset in amortized cost category if it meets the SPPI criteria and if it is held with a business model whose objective is to hold financial assets in order to collect the contractual cash flow. Hold financial assets, which means maturity. You want to keep until maturity. Now I'll keep one thing. I'll give you an example. Let's suppose I say purchase a 5-year bond with 6% coupon rate. Intention is to keep until maturity. Do you think that this particular bond meets the two criteria? The first one is SPPI. So does this bond give me SPPI? Do bonds give SPPI? Yes, they give.
Yes, sir. Yes, sir.
Bond gives SPPI because bond is giving me 6% plus $100 back. And I want to keep it until maturity. So SPPI is met and kept until maturity is this. So it means that we concluded that bonds, they can come into amortized cost if you want to keep them until the end. Now, what we said that bonds always. Bonds will always meet the SPPI criteria. That is for sure. Now we need to see, are we keeping them until maturity or not? If you say I'm keeping until maturity, put it here in amortized cost category. Just like in our case, when we issue bond and when we sold bonds. That both criteria should be met. If two criteria are met, you put it in amortized cost. Now, if you see the third one, now let's see the second criteria. It says fair value to other comprehensive income, fair value through OCI. A financial asset is classified as subsequently measured at FB OCI if it meets SPPI criteria, just like before. So if there is any bond, it meets SPPI criteria and is held in a business model in which assets are managed both in order to collect contractual cash flows and for sale. So if you say that I may sell it or I may keep it, you put it in FB OCI. Now that is very simple, my friends. If I purchase a bond, like this, so I got 100,000. Intention is to keep until maturity. Do you think that, maybe I will keep it, maybe I will sell it? If you're not sure, then it comes here in OCI criteria. Now, very interestingly, you may ask me that if you want to sell it, like the only difference in these two categories is your intention of keeping it or selling it. You say, I'm surely keeping it. Or you say, I may keep it or I may sell it. So this is the only difference. Why do you put them into two different categories? Why do we not put them into one category? Answer is very logical. Listen, if you say that I am keeping the asset until the end, say here, the first one, which was amortized cost. You say that I'm keeping the asset, hold financial asset in order to collect. So if you want to hold it, if you do not want to sell it, why would you measure it at fair value? Fair value is the market value. Market value you only check when you have an intention to sell. If you don't have an intention to sell, why do you put it on fair value? That is the logic. I mean, I'm keeping it for 5 years. I don't care in market it goes up. I don't care in market it goes down. I'm not concerned about that. I'm keeping it until the end. And that's why I'm showing it on my book value. 92, 93, 94, 98, and 100,000. Gone. Market it goes wherever, I don't care. Because in any case, I'm not going to sell it into the market. You have a car. You drive a car. You don't have any intention to sell it. Do you check your car's price every day? You don't. When do you check car prices? When you have an intention to sell. When you don't have an intention to sell, you keep it on book value. I mean, that's very logical. Because you are not selling it, you are not concerned about market value, and there is no gain or loss. Gain or loss will happen that I bought it for 100, I'm selling it for 110, I make a gain, or I bought it for 100, I sell it for 90, I make a loss. In this case, I'm not selling it at any price, neither above nor below. Maybe it go to $150, I'm not selling it. Maybe it drops down to $50, I'm not selling it. So I will neither make gain nor make loss. I'm just using it. I'm just keeping it. So fair value amortized cost, this is the logic. If you go to this one, where it says that amortized cost, fair value through OCI, yes, I will put it in OCI if it meets the SPPI criteria, and because I may keep it or I may sell it. So because I have an intention and a tendency to sell it into the market, so I'm keeping my eyes on the market. What is the market now? Is it up or not? Because I want to sell it. So I must keep it at fair value. And then any difference between the book value and the market value should be recorded into the financial statements as either gain or loss. Market goes up, you make a gain. Market goes down, you make a loss. And you put that gain or loss in OCI, other comprehensive income, not into P&L. The third one, it says fair value through profit and loss. How do you measure that fair value through profit and loss? All other financial assets, that is financial assets that do not meet the criteria for classification as subsequently measured at either amortized cost or OCI, they go to P&L. Everything else goes to P&L. Very simple. Why it is simple? Because everything else will go to P&L because they become your operating activity. Listen, first category means I'm keeping until the end. Second says I may keep until the end or I may sell it until the end. The third category means you are only buying it to sell, because keeping until the end are in first two. You said first category, keeping until the end. Second, maybe keep, maybe sell. The third one has to be only selling. So it means that it is your trading activity. You are buying things only with the purpose of selling it. You have no intention of keeping it. Third category is where you are buying the financial assets with an intention of only selling them. And if you buy them with an intention of only selling them, it becomes your trading activity. And if it is your trading activity, the gains and losses should be shown in your trading profit and loss account. They go to your P&L straight away because that is your operating activity now. This is part of your operations because this is your operations. You buy and sell non-current assets. So this is your business model. These are the three criteria. Criteria were not difficult. What you need to understand, this topic, it almost took out 2 days because we understood the process of, we talked about derivatives, we talked about compounding, discounting, amortized cost, etc. Many things we covered actually. But the classification of assets was not difficult at all. 3 types of assets only. If you talk about financial liabilities, now there are many other topics actually. Now we'll talk about financial liabilities as well, and a few more things I want to speak, but I will continue this thing in next lesson. So any question until here you want to ask?